To news channel where you receive your information about the cryptocurrency business, which is a high risk but with a high reward business. So, welcome once again. So, today we are revisiting the liquid capital. Remember, I presented this protocol some days ago, and this is the video in my channel. I'll just show you just in a second. All right, so I presented that protocol when it was launched. As a matter of fact, it was just launched recently, about 4 or 5 days ago. So, but today, I would like to show you how the APR or the APY is calculated. Okay, because I read the white paper and they presented it how the whole thing is calculated. It's a dynamic APY, which is different. It's not fixed. So since it is dynamic, you as an investor, you can follow, you can do the calculation by yourself, you get the information and see if it is correct, if it is right or wrong. Let me, so this is my channel, and this is the liquid capital. I presented it 2 days ago. That is it here. All right, so today I am back again, but today I'm going to present how the APY is calculated. What you can see, remember, liquid capital is a partner of the heavyweights we have in DeFi. They came together and formed this protocol and then introduce something that is new, dynamic APY. Okay, that should be calculated so that the protocol will be more sustainable, because all these protocols, all the developers, they have seen all their various projects, because each one has its own project. They have seen these projects to have one problem. That is when they rebase, print, mint tokens, and then there is inflation and the value goes down a lot. So the issue is, how do we solve this common problem? So they have come up with an idea to use a dynamic APY that follows the market. So it can no more be artificial, it has to be something real. And this is good. Okay, so this is the dashboard. As you can see, it has a market cap of about almost $5 million, and the price of the liquid capital token, which is called liquid auto rebase, is this. It's 9 cents. It's 9 cents. If we look at the chart, here, you're going to see this is the chart on the screener is here. Okay, so it went down up to 9 cents, but now it's going up to 9.45 cents. Okay, 9.45 cents. All right, so if we go back, if we come back here, you can see it. They set it at 9 cents. Okay, and it says the current daily yield. Okay, the daily yield for you, that is the daily APR, is 2%. Remember, this daily APR changes, it depends. It is not fixed, it's variable. So how is it calculated? Of course, it's now the maximum is 2% daily. Okay, now it is 2% now because this is the first month. I think they do it so that they can motivate many people to invest in this project. So it is 2%. And now they showed you how the calculation is done. So let me just, I downloaded the white paper. That is why I always tell you to read the white paper and see how the whole thing is done. I read the white paper and then it tells me that it says the daily APR will taper down over 4 months. So this is the first month of launching, and then it will vary between the month one will be between 1 to 2% daily, and now it is 2%. This is encouraging so that people bring people to invest in this project. So it's also kind of marketing too. Second month, which will be September, so it's going to be between 0.75% to 1.75% daily. The third month will be between 0.5 to 1.5, and the fourth month will be 0.25 to 1.25 daily. Okay, so they gave you this margin so that nobody will say, no, you promised 1.75 fixed. It is not fixed. It can vary depending on the market conditions. So, how are these APYs or APR calculated? That's why they call it a dynamically calculated APR. So, that is the object of this presentation. How is the calculation done? Now, this is how it is done. So, we say, how is the dynamic APR calculated? Remember, you have this is their white paper. You can download it. Okay, let me just show you where you can just download it from their site. Okay, you can download it from their site. Let me just go back here. I have shown the dashboard. Now let me go to their homepage. So on the homepage you can see it. You can just download the white paper. It's in PDF. I don't think it's in PDF. Okay, but you just click, and then once you click, it takes you. It's not in PDF. So this is the home page. All right. Once you say here, read the white paper. So you click on this. Okay. When you click, it will open like this for you. I have already opened it, and I saved it in my computer. The one I'm showing you in PDF, but it's not originally in PDF. But you can save it in PDF. If you want to save it in PDF, what do? You just click with the right hand here. Then it tells you print. Then you click print, and then it comes up. You see here, save as PDF. Okay, so it is loading a preview. It will just load, and then all right. So this is it, and then you click save and save it where you just remember to use it. So this is how you can, even if it's not in PDF, this is how you can save it in PDF. You just click with right hand, and then click on print, and then print brings you here. So this place is a print. You see save as PDF. If you want to print it on a printer, you go click here. HP, for example, my printer is HP. So you see here, if I want to print it in a printer, I will just click on this place and select HP LaserJet and then print this. But since I don't want to print, I just want to save it. I will just come here and say save as PDF, just save it. And then you click here to save. Alright, so this is how you can do it. Okay, so once you come to the white paper here, then you can read to get all the necessary information, how Liquid AR works, get all the information you need. So it is from this that I got this calculation here. It says how is the dynamic APR calculated. So you can see how is the dynamic APR calculated. So once you click here, then you get something like this. You now save it as I presented to you. How is it calculated now? Let's see. You say the Liquid AR. Okay, remember Liquid AR is a Liquid Auto Rebase. The name of the protocol is Liquid Capital. Okay, and the name of the token is a Liquid Auto Rebase. We take the time weighted average of volume over a 7-day period and current market cap, MC, discounting supply burns at the end of the week to set the weekly daily APR for the next 7 days. APR calculation is as follows. Now, the average time weighted average volume of sales or transactions. So how do you obtain this? Now, if you go to the DEX screener, for example, it can be DEX screener, or you can go to the CoinMarketCap or CoinGecko, they will give you all these information. So if you come to this one is a DEX screener, okay? If you go to DEX screener, it will show you, you write the name of the, you write the name of the token you want. For example, here I will just write, what's the name of the token? LAR. Then it gives me, it presents this for you. Now it says here, so when you go to the, okay, so you can see LAR, liquid auto rebase, okay? Then you have many of them in this place. So which one are you going to use as the real correct one? You look at the one with the maximum liquidity, because when you are going to invest, this is the one you are going to use. For example, here in this one here, it says what's the price? 0.1. Okay, what's the liquidity? $190. So if you invest in this one, when you sell it, there will be no liquidity. So whenever you want to invest in any protocol, you can come to the next screener, you put the name of the token, it appears, and then you have to look at the where you have the maximum liquidity of the protocol. In this case, remember this thing is launched on Binance Smart Chain. This is the symbol of Binance BUSD, Binance Smart Chain with a native token BUSD. Why? Because this liquid auto rebase token, the pair, when you want to invest, the pair is BUSD. It's not BNB. Remember, Binance Smart Chain has two tokens. It has BU, that is the two native tokens, which are BNB and BUSD. So whenever you see this symbol here, symbol means a BUSD. That's the pair. That is, you need to have BUSD in your wallet so that you can buy the token you want. All right. But when you come here, this is the symbol of the DEX where you can buy it, and this DEX is also on the website of the Liquid Capital. It's the Orbital DEX. Okay, so what is the price? I told you 0.09, approximately 0.095. Okay, or we can just say 9.5 cents. And the liquidity is 2.8 million. So in this one here is what you got to click. Remember, I'm trying to tell you how you can obtain the volume of transactions they will use for the calculation. So this is the chart. As you can see here, some people are buying, some are selling. Now, when you come to this side, you have the price in USD, which I have told you before. This is the price. Liquidity 2.8 million. Then market cap is 5 million. And the FDV means a fully diluted volume, which is also 5 million. Why are the two the same? Because this thing was recently launched about 4 or 5 days ago. So whenever a protocol is recently launched, the FDV is equal to the market cap. Okay. The FDV means that is, if you sell the whole number of tokens, what will be the value? So until now, the ones they have sold will give you the same as market cap and the FDV. But as time goes on, when they sell more of the tokens, of course, the FDV, okay, the values here will change. Now, here they give you other statistical data. All right, here 5 months, is it 1 hour, 0.36. For 6 hours, you have minus, negative, 0.43. 24 hours, they have an increase in transaction volume, which is 5.3. But this is not what is interesting to you. What is interesting, how do I get the volume of sale transaction? This is where it is. Say transactions 162, buys 116, sales 46. If you sum the two, it will give you 162. Then what is the volume in terms of dollar the transaction? Okay, on today, all right, for today, but it says it will give you the 24 hours transaction. It will be here. Okay, for the last 24 hours, the transaction was 60K. That is $60,000. So this is from where you can obtain the volume of sales. Now, if you want anytime you want to check, this is the ID of the token. Okay, and then if you click here, you can put it anywhere on the PancakeSwap also. This is the official address of the token. Okay, this is the official. This is the token. This is the pair. The pair. This is the address. And then this one is liquidity pools. Okay, but then what do you need here? You just come here and check what's the volume for the day. You check it for 7 days. Every day they will tell you the volume for 24 hours. And then you record them for 7 days, and that is what we are going to use here. The volume is a time weighted average volume, which means what? The volumes you record each day for 7 days, you sum them and divide by 7. That is the average. Okay? So this average, you have got it. And then the current market cap. All right. I've shown you the current market cap. You can get it from their website, or you can get it from the DEX screener. For example, here, what's the market cap? 5 million. All right. So now we have got the average volume. So within 7 days divided by 7, now you have the daily average for the last week or last 7 days. That is this. Now, in order to calculate the APR daily for the next week, because they use the values of the last week to calculate the APR for the next week. So how is it done? Now they use this volume, the average volume, multiply by 0.05. Why 0.05? Because this volume traded within 7 days, the average divided by 7, that is the daily volume. Why 5%? Because 5% is the value. It says the average volume multiplied by 5% determines the average daily amount accrued by the insurance fund during the previous week. So during the week you did the calculation, so you have to know how much was collected in the insurance fund. Okay, so this amount collected in the insurance fund, you have to get the 5% of that. Okay, so that is why here they say daily APR is the volume average multiplied by 5%, which is 0.05, because this 0.05 is the whenever they make the sales, this 5% goes to the insurance fund, and this insurance fund is where they are going to use to pay out the rebates. So now they use this volume multiplied by 5% divided by the market cap, and then multiply by 100 to put it in percentage. This is how they do the calculation. Now they use an example. If the average, the daily average for the last 7 days was 3 million, that is the daily average transactions for the last week. For the 7 days, the average, that is every day, 3 million. And the market cap in this case is 10 million. And then how do we calculate this? Now we say the APR daily for the next week will be this daily average multiplied by 5% divided by market cap multiplied by 100, which will give you 1.5%. So in this case, the daily APR for the following week, they will be set by 1.5%. If these ones change, for example, if we have the instead of 3 million, it becomes probably 2 million, and the market cap, we're in a bear market cap goes down to probably 5 million. Everything here changes. Down here you put 2 multiplied by this, okay, divided by probably 5, the value will be different. Okay, so let's see what it will. Imagine this to be 2 million and this one to be 5 million. Let's see what's going to give us 2. We have 2 multiplied by, let me see, we have 2 here. In the case we have 2 million multiplied by 5%. So imagine we have this. Just have patience. My computer is kind of slow. So imagine the instead of 3 million daily average, it becomes 2 million. So it becomes 1, 2, 3, 1, 2, 3. It becomes 2 million multiplied by 5%, which is 0.05. 5% means a 5 divided by 100, which is a 0.05. So it becomes this. Then imagine the market cap goes down to maybe 5 million. Then we divide by 5 million. 1, 2, 3, 1, 2, 3. So that's it. 0.02. Now we multiply by 100. That is to transform into percentage. So it becomes 2%. So if that condition occurs where the volume of transactions was very high, but the market cap got reduced, that is what you should expect, because here reduces, but here goes down more than this one here got reduced by 50%, and this one got reduced by 33%. So what you have on this side should be higher when you compare with this. That is why instead of 1.5 it becomes 2%. All right. So this is how the calculation is done. Remember, what do you need? The average volume of transactions, that is the average means for the last 7 days, each sold per day. Then you have the market cap, the current market cap, and then you do this calculation here, and then it will give you the daily APR they will set for the following week. That is how it is done. And I have shown you how do you get this. You can come to the desk. You can come to the desk screen and here you get it. The volume is this. Okay, you get it. That is if after every 24 hours you come here, you record it every day. You record for 1 week. Okay, for that 1 week you record. So you sum the whole value and divide it by 7. That gives you the average volume negotiated per day for that week. So that's how you do it. And then market cap is always here. You just check what's the current market cap. You got it. So you do that as simple arithmetic, and then it will help you to understand how this APR is set, so that you can follow it. Whenever you can go to their website, you can see, you can check it by yourself and see if it's correct or if it's not. So this is the information I have for you today, and I hope you love it. I hope you will like it. And in case you really like it, I would like you to click the like button, subscribe to my channel, and then hit the notification bell so that whenever I upload the video, you can just receive it and take your action as necessary. Remember, this is not a financial advice, it's only for informational purposes and education, just to help you make your own decisions. And then from where do we have this money in the insurance fund? Remember, 5% of the transactions, they go to the insurance fund. Okay. And then how it is done, because we have the buys and sells. Okay, we have the buys and sales tax. Okay, so all this money that we collect from buys and sales taxes, they go to the insurance fund. Okay, they go to the insurance fund. 5% of the money we collect from taxes also on sales and buys, they go to the insurance fund. And then from there we can get the numbers to do the calculation. So here, what's the buy tax? 15%. What the sales tax? 20%. But it said the initial sales taxes will be 26%. Why that? Because the initial, that is now, if you enter into the protocol, I don't know for how long it will, it's a higher to help control volatility and reward our long-term investors. Okay, so now it is 26. I don't know for how many months, whether 3 or 4 months. Why? Because many people buy at the pre-sale and dump everything. So they don't want it. If you want to dump, you now have to pay 26%. So to discourage people doing it. All right. But on a long-term sale tax will be 20%. but 26 will be an issue to discourage people from selling. Because all these protocols, as a matter of fact, everything in investment goes by compound interest. That is, you buy and hold it, so that it brings a stability to the protocol and to the price too. Because if everybody would dump and sell, the whole thing goes down, and investment goes by trust, and by trust, and also you have some human behavior in that, psychology. People will think it will go down to zero, and they will run, and eventually it goes down to zero. So that's the point. So when you buy and hold it, it is good for the protocol, and it's also good for you because it's going to appreciate. The value will rise. If you don't have a lot of that token on the market, eventually the value will go up. But if everybody will start selling, 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 then some people will look at that in the psychology. Oh, this thing is going to worth zero. They will just throw it in the market, and the price goes down to zero. That is why many protocols today, recently launched, are having problems. It's inflationary. Everybody wants to sell, to take the profit and run away before it gets down to zero, and then okay. So if you do it with this one, you are going to suffer, because you are going to imagine you paid 15%, you sold. When you say you pay on another 26, 25 plus 15 will give you 40%, 41%. So it's not a good business for you. You cannot gain 40% uh, in few days. No way. So it's not a good business for you to buy and sell even within the first month. It's not. So that is why they limited it. Did it this way. All right. So this is what I have for you today, and I hope you enjoy it. And if you also like it, you can make a comment. Tell me what you think. I will still look for other DeFi projects and present to you. Some people are requesting me to look at the Pulse sex on the Pulse chain, the currency, and also the hex. So I am going to do that, and very soon I'm going to make a video on that one and show you what is really happening with the Pulse chain at the moment. Alright, so thanks you for watching, and then I will see you in my next video.